Hey guys, my name is Nicolette Mashile. I am also known as the Financial Bunny. Welcome to the Financial Bunny TV. Today we're talking all things trading versus investing. Now this video is brought in partnership with OctaFX. OctaFX is a forex trading platform where you can register an account and you can start trading different currencies. Today, as I said, I want to speak about trading versus investing. Now remember that none of my videos constitute as financial advice. If you are looking for financial advice, please do speak to somebody that is certified and registered with the FSCA. Have you ever heard the saying, you give the two people the same problems, they're going to give you two different solutions? Or when they say, don't worry about people copying your strategy because you have your own secret sauce. And that's basically what it comes down to. Trading and investing both seek to make a profit. However, they both have their own secret sources as to how do we get to these profits. The reason I say that is because there are quite distinct differences between trading and investing. However, as I said, the main goal is for whoever is involved in both practices is to make money. So let's start off at time or period of time. When you are investing, most investors invest for the long term, right? So when they choose how they're going to select what asset class they're investing in, they look at it from a longer period type of term. There's a strategy called buy and hold that most investors use and employ. This means that even when there are volatile markets or there's volatility in the asset class that you have purchased, you will ride through that storm. So currently we talk about having a bear market, which means that most markets are going through a lot, right? And many people's values of their portfolios has been wiped off. And a lot of people who are investors and believe in the investment principles will ride through this wave. And the reason why they're able to do this is because they don't buy based on a technical look or approach to whatever asset class they are buying. They look more in terms of what is the strategy of the company, the business model. So it's a holistic look as to whether or not this specific, let's say you're looking at in buying the stock market or stocks in the stock market, you look at the specific company and you say, okay, because this is company XYZ, because of the board of directors they've got, because of the business strategy, because of the model, because of their corporate responsibility, I believe that this business share price is going to grow over the long term. So you then buy and invest your money into that specific business. If you are trading, for instance, you are looking at more short-term positioning, right? So you would say, let's say, for instance, you are in the business of buying currencies. So you are a forex trader. You will have, for instance, a position that you open up at 9 o'clock in the morning and you close it up at 3 o'clock in the afternoon. Sometimes it can even happen over minutes. That's when we talk about you trying to beat the market. So basically, you would have concluded what is called a day trade. So when we talk about beating the market, people are saying, yeah, but that's not a good strategy. No, there are strategies that you can look for. Oh, for instance, there are what we call technical strategies. So you can look at pricing as a strategy for you to be able to make greater returns when you are doing short-term trades. You could also look at what is happening in the macroeconomic space. So there could be a change of leadership in a country, in an economy, right? There could be an announcement that a country is making on policy issues. And all of those things could potentially change the currency's value, right? Sometimes it's not even in that home currency or that home economy where changes may happen and it will affect, especially for emerging markets like South Africa, for instance. The rand is affected sometimes by what happens in macroeconomic spaces of other countries. So that's basically now on a time perspective, right? When we look at a risk perspective, now we know that in both investing and trading has and carries some level of a risk. But however, it is easy for you to be able to identify what type of risk profile you have when it comes to investing. And then what you will do is you will then employ an investment strategy that accompanies or accommodates your risk profile. So if you know you're somebody that doesn't have an aggressive risk profile, you're obviously going to trade assets that have a less risk. So you may even be looking at going into investing in cash, because we know cash is not as volatile, for instance, versus real estate. You may, if you're looking at the stock market, looking at the more conservative stocks versus going into the mining sector, for instance. But also remember that over time, you are able to start gauging which industries have far more risk based on market conditions, and you can plan for those types of things. So that is what investment looks like from a risk perspective. When it comes to trading, of course, you know that you can either have a loss or you can have a win when it comes to your trades. So even your day trades, you could literally open up a position. Let's say, for instance, you are trading on the OctaFX platform. What you can put in is what we call stop losses, right? To make sure that you don't find yourself in the negative. In actual fact, the platform itself caters for that once you go below what your margin is, the platform itself will then close your trade. So there is ways to mitigate risk when you are trading, because we know that when you're trading, trying to beat the market is almost similar to trying to time the market. Despite how noble your strategy may be, things can go haywire, right? So, however, we find that platforms like OctaFX will then have a strategy to be able to assist you in managing that risk. The third thing you need to look at is liquidity. Now, of course, we know that if you are investing and you're investing long term, it means that you lose a level of liquidity. What is liquidity, rather? Let's start there. Liquidity basically is the ability for your money or your assets to quickly become cash, for you to be able to convert those things. So having cash on your hands, when you have cash in a bank account versus somebody that has a property, we say that the person who's got money is liquid, right? Because their money is quickly converted into cash, or they've got cash on hand. So when it comes to investing, we know if you are investing for a long term, it may mean that, for instance, if you invest in the real estate market and you buy a property for rental purposes, you may find that maybe 500,000 Rand of your money is tied up into a property. And if you are very unfortunate and we're not in a buyer's or in a seller's market, you may find that it takes longer for your property to be converted back into cash. So that is why investing often has a lower ranking when it comes to liquidity of money, right? Or liquidity of assets, because when you're investing for long-term purposes. When you look on the other side in terms of trading, because you are trading and you are moving things very quickly. So for instance, if you open up a position on a forex trade, that means that by either end of the day or maybe in two days or in 3 days, you are closing that trade, you get your money back as cash, and you're able to move on with your life. Stock market, for instance, if you're trading again in the stock market, you are doing very quick transactions that could potentially allow you to have a high liquidity rate, simply because your money is not tied up on a long-term strategy. It's tied up for short-term strategies where you want to make maximum returns. And the next thing that I want to speak about is diversification. There's an old adage that says, don't put all of your eggs in one basket. Now, when you look at the investment world, there's quite a number of financial instruments that are available for you to invest in that give you a level of diversification. For instance, if you're looking at the stock market, you could invest, for instance, in an ETF, an exchange traded fund, a unit trust, or any other type of mutual fund, because they have diversification already worked into that financial instrument. So it's not just about investing in individual assets like buying individual stocks or buying a rental property. Even within real estate, you could still find diversification through a REIT, a real estate investment trust. So there's a level of diversification that can take place when you're looking at investing. Whereas with trading, you may find that there isn't quite a big opportunity for diversification. For instance, if you are trading a currency pair in forex trading, you would be trading, for instance, something like the dollar and the rand. Now that gives you two economies that you are working with. So there may be a level of country risk, for instance, where, as I said, macroeconomic issues within that specific region that could then throw away that level of diversification, because you are dealing with two economies versus if you were going into a trading or a trade that has a level of diversification. The last but not least thing that I want to speak about is, of course, potential returns on investment on investing and on trading. So if you look at something like investing, we often say that higher risk, higher return. But however, what we need to look at it is higher risk and potential higher return. Simply because it's something that's over long term, there is potentially a risk of inflation that you may come across, or the asset just does not perform the way you would have expected it to perform. We've seen many stocks or share prices really take a huge tumble, and when somebody needs their money and they need to change it back into cash, they're at a point where the volatility kind of knocks them, but also inflation. But if you want to calculate the return on investment on your investments, you take the profit and you divide it by the cost of you getting or acquiring that investment, and you will potentially get how much you've actually made as the return on investment, and you multiply that by 100 and it tells you how much percentage, what is the return on investment rate. Now when it comes to trading, the world is just your oyster there, because your return on trading can differ from day one to day two based on the position that you've taken. However, there is a leverage risk, which a lot of traders do, is that they may take a leverage far bigger than what they actually can afford. And that's the risk that comes with the return that you can get on trading. However, if you are safe and you are playing it safe, you can find a margin of where you want your return to be. And many traders find that, anything between 10 to 15% return on whatever position they have put on their trade is actually good enough. I'm hoping that I've given you some insight in terms of the differences between investing and trading. I do remember again, the video is sponsored by OctaFX, and it is not meant to be financial advice, but rather education.